Good morning, everybody. It is September 24th, 2021. The Fed met this week. Somebody asked me why I don't cover more dividend stocks, and I thought we should revisit stagflation because we are on the verge. You all know that I read Forest for the Trees, and I have a discount link for you if you want to also read it. Basically, he's considered one of the top macro summary guys out there. And I said a few weeks ago, if you have been listening to these videos, that we should be really concerned with stagflation. And this is something that I've been talking about for a number of years, that we were pushing ourselves in that direction. We weren't solving problems. We were using monetary policy to juice the markets and pour money on all the fires, but we weren't getting the productive uptick that we needed. And productivity has been a problem until very recently. So you ask yourself the question, if the economy is not really growing organically and we keep printing money, will there be inflation? Well, the answer is yes, and we're seeing it now. Other part of that is, what if we're not at full employment? What if we're not getting the growth of the economy that we need to offset the increase in all the money that's out there? You get slow growth and inflation, or no growth and inflation, or a recession and inflation, which is what we saw back in 1980. The problem that the economy has right now is that we have systematically decided over many, many years not to fix the problems that we have, and it's starting to catch up with us. And the question we have to ask is, well, will this destroy America? Will it collapse the dollar? And the answer is probably no, but it does mean that we're going to have to go through a period of time where things aren't quite balanced. Because we don't have the stomach to have a depression, and I don't blame us, and because we don't really even have the stomach to have much more than, 2 or 4 or 5 down quarters in the economy, we opt to print money. But we don't choose to really build back better. We don't choose to support the middle class. The middle class doesn't choose to support the middle class. And we accept policy that leads to greater and greater wealth inequality. Some of the people in the top 10% are okay with that because they're, hey, I'm in the top 10%. I will warn again. If you think the snapback of Trump, if you think the snapback of the socialists so far has been bad, you're fooling yourself. Because sometime this decade, when we get stuck between a rock and a hard place with the retirement system, I'm not sure what we're going to be able to do to fix that. Because if we allow it to get to crisis levels, which we're basically on track for sometime late this decade, I've seen estimates of 2026 at the earliest, 2031, 32 at the latest. You know my opinion on estimates. Usually the most aggressive estimates are right because there is an institutional imperative to not be too out in front. Because, oh my God, if I'm the leader here and I'm wrong, end of the career. So your independent analysts and a lot of your corporations will put out what they really think as a particular case scenario. They'll have their base case, but then they'll put their what if it goes this way case. BP, the oil company, is a great example of that. They have their base case on petroleum. Basically, we're going to be at peak oil demand in the middle 2030s. That is their base case. But what they're basing their corporate decisions on is not the base case. And that's a tell. One of their case scenarios is that peak oil demand is basically here in the next few years, and that oil demand starts to fall by around 2030. That's what I've been saying. So the question is, what are they saying to appease shareholders and keep skimming their money for the executives? And then what do they really believe, which impacts corporate policy and how many shares the executives sell in the short term? Well, in BP's case, it's pretty clear, right? With them cutting exploration and trying to transition back over to the green side, which they tried about 15 years ago and then they abandoned and now they're back. You see the things the executives are investing in, and more importantly, what some executives are leaving to go and do is they take their payouts and then they go somewhere else to a smaller company that's involved in the clean side of energy, the clean energy revolution. Remember that advice you got as a kid? Don't listen to what people say, watch what they do. There's a lot of that going on out there right now. And for whatever reason, we are allowing things like this to happen. QE has driven up the value of assets. It also caused inflation, which is pushing tax receipts up. It's almost all from capital gains, income taxes, capital gains. Take a look at the Social Security taxes. The Social Security taxes have gone down lately. How could that be? If you're earning income, you should also be paying more Social Security taxes. So what does this represent? What does that divergence represent? It represents a lot more money going to the top and fewer people being employed to pay Social Security taxes. The investors are winning. What do you think that means when 60% of the people in the population have no meaningful investments? 30% of the population just have a token amount, maybe have a few $100,000 by retirement, and 10% of the people have all the wealth. I mean, literally, it's like 97, 98% of all the wealth. I mean, 1% has 70% of all the wealth. What are those snapbacks going to look like? Well, already starting to see the interest expense on the debt go higher and higher when combined with spending. We're spending more than 10% more than what we take in, and that's with much higher receipts. Think that through. Record tax receipts, and we still can't balance the budget. And as I've said, we don't really need to balance the budget. We just need for what we're over to be about the same as inflation, which should be around 2%, which should be in line with population growth, which isn't really that high right now, but we'd sure like it to be because it used to be. Constructs that are out there right now, and I've asked you to unlearn a lot of things, and I get ignored and I get fought with and I get complained to. The breakdown in the constructs of the post-World War II era and the baby boomer boom to now is monumental. It's why I said it is now the markets of the apes. If you haven't watched this from earlier this week, you should. I got it up a little late because I was having software problems. My nephew in the Air Force texted me about trading, and he thinks it's hilarious that the general population of older folks don't get that it's the millennials, the Redditors, the apes who are moving the markets. Because a fundamental lesson such as marginal money, which every business owner understands, is completely unappreciated by the investing population. The investing population doesn't understand that it's not the first dollar or the second dollar that goes into an investment or a market that moves the price. It's the last one. And the millennials are the last dollar in, but their dollars are growing. So if you think that the influence that the millennials have on the market right now is a blip, if you think they're just going to get washed away, you have no idea what you're talking about. You're ignorant of the reality of basic economics here and the fact that it's a growing population in relative terms to the boomers, right? Because boomers are dying. And their incomes are going up because they're smart enough to leave jobs that aren't paying them enough. When somebody offers them more money, they take it. And they demand more money. And they demand better office space. They demand this, they demand that. Or they just leave, they walk. I told you the story before that I had a client who worked for ABB, making a certain amount of money, a certain amount of vacation time, and they moved their operation out of the Milwaukee area. So he was looking for work. He says to me, I just hate that I have to go back to 2 weeks vacation. He's in his middle 50s at the time. Late 50s, probably, middle late 50s. I was like, what do you mean? He goes, well, I can't ask for more than 2 weeks vacation. I'm like, why the fuck can't you? I tell my girlfriend that all the time. She's looking for work. I think she's going to get the vacation she asked for. I told her, I said, look, if it's not a remote job, you tell them that you want 4 to 5 weeks of vacation. Maybe not the first year, but certainly by the second year. Well, I can't do that. Well, I'll tell you what. The millennials are doing it and they're getting it. You know why? Because there's tightness in the labor market, even though there's unemployed. Why? Because we have 7 to 10 million people who aren't working, because why bother for 10 or 12 bucks an hour? Just saw an article, a shop owner down in Texas was complaining that the big companies stole his employees. He needed about 8 people per shift to keep his taco stand running. Basically, his own version of Taco Bell. It was like John's Taco Bell or something, but not Taco Bell because that's a copyright infringement or something. And so it was like Taco Kitchen or Taco Couch. It was a weird name. I think it was like Taco Couch, like sit down on the couch and have a taco. In any case, he was complaining that, well, they're offering too much pay and they're offering $5,000 in tuition assistance and they're offering benefits. I'm a small guy. How can I afford to compete with that? So the reporter asked, how much do you pay your folks? He said, well, it's a reasonable amount. This guy, the reporter checked, was pretty rich. He'd been skimming a little bit off every taco for a very long time. He hadn't worked in his own restaurant in years. So rather than raising the pay just to keep the drive-thru open, right? Because if he's got the drive-thru open, probably still making 70 or 80% of his revenue. Could have done that with 1 extra kitchen person, according to him. And if he had worked in the window, he didn't want to do that. He said, well, I'm not going to go work in my own restaurant. I'm not going to pay these people $15 an hour. So he shut it. He shut it down. He blamed it on the system. Blamed it on other people. A lot of blame goes around too in a stock market correction. But it's all over the place. I watch the community posts in different communities around Wisconsin and around the country where I have friends. And all sorts of business owners. Well, I can't afford to pay these wages. Some of these people are working hard in their own place to make it happen. Other people are like this Taco Couch guy. I just don't feel like doing it. I'm going to sell the real estate. I'm not going to work in a window. $15 an hour work. I mean, think about the mindset. He won't work in the place he owns when things are a little tight. And this will be temporary. It always is. And I bring this up because when this next big correction comes, and we're seeing the signs of it now, whether it's this year or next year, whenever, people are going to act entitled and they're going to blame other people. When you start hearing that stuff, it is one of the greatest buying opportunities ever. And the apes here are probably going to help make that happen because, again, they are the marginal money. They're starting to buy puts. I showed that to you. My nephew laughs at the other investors. He's like, they just don't have any idea what they're doing. I was like, you're right. They steadfastly refuse to learn technical analysis, even basic stuff like RSI, which is what I want you folks to all focus on. If you just look at the relative strength index and compare the daily, the weekly, and the monthly, So easy. So easy. Keeps you out of trouble. Actually will reduce the amount of trading that you do. If I go back to here, and actually here, I talked about stagflation about a month ago. What do we see here as he goes through his article? Whole section on stagflation. He's one of the best in the country, and I told you before he did. So I'll make a prediction. I don't think the Federal Reserve will finish their tapering program. In fact, I think they raise QE again by next autumn. I think they start lowering it in November. I think they get slowing down in the first quarter in the economy. I think they stop with the taper and they level it off. They hold it steady. And by autumn, Jay Powell adds more QE. And I don't think we see interest rates go up until 2025. And probably only if this reconciliation package gets passed. I'll tell you what, if we don't pass this reconciliation package and fund it with higher taxes on the super wealthy and finding a way to keep super profitable corporations from avoiding taxation, now honestly, I don't even know that we need to raise the corporate income tax. We just need to stop them from cheating. They cheat legally, but it's cheating. They got the rules changed so they could do things that used to be illegal so they could save taxes. So don't ever fall for that argument, well, but it's legal, so they might as well go do it. They're the assholes that got the law changed with the assholes in Congress who are bought and paid for, probably 80 or 90% of the Republicans, probably half of the Democrats. And that's just now. I'm sure it's been the other ratio before. Well, in my lifetime, the Republicans have been more corrupt. And remember, I was born into Nixon, and then you've seen what's happened in the last 20 years. And really what really started in the 80s. Because in the early 80s is when we started to be gigantic deficit spenders. That was a Reagan and Congress thing. Because Reagan wanted to cut taxes, which was probably right. Not the way he did it, but in theory, cutting taxes on the middle class usually makes sense because they're the spenders. But he started the whole trend towards lowering taxes on the rich with a token amount for the middle class to buy them off. Congress didn't have the nuts budget close to balanced. And there's a theory, and I kind of buy into it, that one of the reasons we overspend is to keep the dollar from going way up in value. Ultimately, the markets won't allow that. And I've been waiting for 2 decades for the bond vigilantes to push interest rates up, bring some balance, not complete balance, because I don't think we can get there, but more balance back into the system, spending versus income. We're always going to overspend. It's just, it shouldn't be more than a couple percent because of population growth, because of planned inflation. But right now, interest rates are doing something funny. Only twice, Treasury yields fallen so far below inflation. It's the 3rd time. And in the last 2 weeks, you've seen this little uptick. So the question is do we jitterbug around here? Well, the other 2 times we didn't. It just jumped. So if interest rates jump back to say they were a whopping 9 months ago, what happens? Well, the dollar gets stronger. The dollar gets stronger because credit got tighter. What does that mean? Well, it means that a lot of companies are in trouble because they need the cheap financing to keep paying their dividends, to keep floating their operations. So here is a list of all the dividend payers in the S&P 500 that I keep track of. It's like 364 of them. I'm going to rank it by dividend yield, top to bottom. Because I got a complaint that I don't focus enough on dividend stocks. I just want to let you know that I do. Dividend yield isn't my primary focus. The quality of the company is. I'm going to show you a chart here a second. It should get you to understand what I'm doing. There we go. So I got a complaint that I don't focus enough on dividend stocks, and somebody wanted safer dividend stocks. Well, there's the misconception that somehow dividend stocks are safer than other stocks. They're not. Stocks are stocks. These are companies. The dividend, you'd think, represents a strong company, but that's not true because they're using the dividend to suck in investors to push up share prices so the executives can use their bonuses to make a bunch of money. We saw last summer during the coronavirus crash, all sorts of companies cut their dividends and all sorts of share prices drop over 50%. Yeah, well, that was because of the coronavirus crash. No, it's because these companies just weren't that strong. So the Federal Reserve prints $6 trillion now to help bail everything out because they need the higher tax revenue from the higher share prices too. But the question becomes, can you do it forever? And the answer is self-evident. You can't do it forever because the other markets will adjust. And historically, you have seen cycles. Just another cycle. But it is part of a spiral to a moment in time that we're going to have probably this decade where we have to do a lot of resetting. And we're trying to do it through inflation right now. We're trying to tell people that, oh, it's okay, you can handle it. So I've been shopping for fish. Fish are harder to get now. And I just subscribed to something called the Alaskan Fish Company, I think it's called. Didn't do all the research on it I should have. But they had a Facebook ad, so hey, it can't be wrong. So I'm now buying $130 worth of fish from them every other month. Packed in ice, frozen in Alaska or Seattle area or Vancouver, and sent directly to me, no middleman. Fresher fish, lower price. I just gotta make sure I'm there on the day that they deliver it. Inflation isn't rampant and it's not hyperinflation. And it can't last forever. The price levels probably never go back down. So think of it like a stair. We just took a step up to a new stair. There's a minor part in the reset that's coming. When the reset coming becomes more apparent to more people, and there's enough press out there, media out there talks about it, the biggest reset will probably be in the bond market, followed by the stock market. When it happens, it's not going to be the dollar collapsing. I've gone through this with you 100 times. Relatively speaking, the United States economy is so much better than every other major economy. And our system is so much better. Our military is so big. And our geography is the best in the world. Productive capacity is the best in the world. Our currency will always be the strongest in the world the rest of your life. Doesn't mean it won't go through cycles. But the minute we stop overspending, because we have to try to bring things in line just a little bit, dollar goes up in value. Finding balance at some point will be required, but we're just going to keep going from a little over to a lot over to a little over to a lot over, probably for a long time. And the moments in time when we spend a little bit less are basically just so that we can spend more later. Think about the last time we tapered. Powell said he's going to start raising interest rates until, voila, not only did he not really raise interest rates, he did more QE. It's like, bring me a gun, shoot it out, reload, shoot it out. Bring me a bigger gun, shoot it out, reload. Bring me a bigger gun, bring me a bigger gun, bring me a bigger gun. That's what's been going on for 40 years. And we are finally testing some of the limits to the point where there's a popular monetary theory out there, modern monetary theory, that just says, just keep printing money until something bad happens. Whether we acknowledge it or not, that's pretty much what's going on. I can't tell you exactly when something bad happens. But from my view, it seems like something bad will happen when the retirement system just can't handle paying the bills. Social Security is not that big of a deal. That's pretty easy to fix. But Medicare, that's a tough one. Are you going to tell grandma she can't have her pills? Are you going to tell your neighbor, hey, country just can't afford for you to have surgery, so you live 10 more years. I don't want to sound like a conspiracy theorist, but I always wonder, did China let COVID out of the bag because it's the perfect disease in killing the old and the sick? Doesn't affect most people. If you have a health condition that could be expensive, or you're rolling into that last year of life where it's going to cost $1 million to keep you alive for a year. Yeah, maybe we should invent a disease or find a disease. I think they probably found it. They didn't invent it. Then release it into the wild. Let's jumpstart this thing. Just saying. Not saying, I'm just saying, as the kids would say. Anyway, back to dividend stocks. When you use Stock Rover and you do some screening, you find some very interesting things. So I'm ranking this by biggest dividend payers out there. We are invested in 3 of the biggest dividend payers, and they violate some of my rules. Why? As I've told you, with Lumen and AT&T, they both have assets that are incredibly valuable, fiber, that can't be replaced. And AT&T was able to spin off a bunch of their entertainment assets, and they're slimming down now. They'll probably get a valuation similar to Verizon soon. Meanwhile, you get all the Discovery shares. So there's something extra. And almost every company on this list has red flags. Not all of them, but almost. 3/4 for sure. But probably 80-something% have red flags. So when a company has red flags, 2 things, right? 2 things. 1, don't ignore it. Figure out what it means. And then figure out, has the market overreacted? In most cases, the market has not overreacted. Sometimes it does. And to me, Lumen and AT&T are worth double or triple what they're trading for. Kinder Morgan, and I'm an old oil and gas guy who is reformed. I've always been a clean energy person. I just knew it would take time to get here. Why would I be in Kinder Morgan when in general I'm not in hardly any oil and gas stocks? And I think most of them are bad ideas. Because why? Because they have this really huge pipeline network that nobody else is ever going to be able to build again. Again, right? It's protected. But it's natural gas, primarily, not oil. And they're the biggest carrier of CO2. And, right, as we go into the era of carbon capture, CO2, and they can use their gas pipes or build parallel pipes to do more CO2, because we know that all the oil fields and gas fields in America are still spewing out methane. So why not capture it? Then use it for something else like plastic or jet fuel, and then bury the waste. Start moving towards what Amidas has been talking about, carbon neutrality in the use of fossil fuels by recycling the waste of other industries, such as agriculture and sewage treatment plants. And by the way, Kinder Morgan is a backdoor play on what element? I'm not going to tell you. If you haven't been listening, I'm not going to tell you. That's right, hydrogen. Why don't I invest in Williams? Well, because I'm in Kinder Morgan and I think it's a better company and a better play. But I actually think Kinder Morgan and Williams might merge someday. Make a lot of sense, actually. So I don't have any color here because it's not a good idea. It's not a bad idea. It's probably an idea that I should look at. In fact, I will. Yellow means I'm interested in looking at it. Red means I wouldn't touch with somebody else's money. And for me, that's important because I manage other people's money. Dow, right? Interesting. AbbVie has warning flags too. But with AbbVie, you come over here and you say, oh, look, $11 of free cash flow, which is double their dividend. I can live with that. So now let's say we rank this by industry. You start flying through here and go, okay, what industries don't we want to touch? I'm not really interested in anything in clothing because big clothing places aren't popular anymore. If you want to make a bet on the next True Religion jeans or, the next Gap or something, Bet on the small ones that are growing hyper fast because the young people love them. All this stuff, tell you what, it's getting easier and easier, buy your clothes online and in boutiques and secondhand stores. These companies get beat up every time there's a recession. Even TJ Maxx, which I used to invest in. Asset management, I'm very familiar with. They all have margins that are compressing. Banks could, for the most part, all be red, but I haven't studied each individual bank, and I'm sure there's 1 or 2 or 3 regional banks that are favorable. But you better do your homework on these banks and have a reason why you'd invest in one of these banks. Is there a bank here that's going to significantly benefit from supply chains moving back to their region? Those are the types of arguments that you look for. Otherwise, the banking system's under huge threat from the digitization of everything. There'll be a lot of consolidation, and that's something you should watch. But if you can find a bank in these regionals that you think would match up perfect with another bank in the regionals, then maybe those are 2 banks to take a look at investing in. Do they have the synergies? Do they have a way of using technology and closing branches that overlap? Can they adapt to the new economy that's developing? I haven't done a lot of research on that. I suspect that there's some yeses in there. That's why these aren't red, they're just pink. You got to figure it out. And I haven't completely color-coded this. I just started. Household products, I'm not interested in any of these. Why? They don't grow. In an inflationary environment, they're pressured. They're really actually not that hard to compete with. I'm buying a lot of my stuff on Amazon now that are my reusable things. Put it on subscription. They give you a discount. You can get green, right? You can get clean products if you want. Because it's on subscription, the discount basically pays for upgrading to clean stuff. These companies are all under huge pressure. Church and Dwight probably ought to be checked, figure it out, because there are more brands than they are toilet paper. There's probably 1 or 2 other ones in here that should be magenta. Somebody asked about one of the companies here. Most of the oil and gas, shouldn't touch them. Why? I've been through that before. 1, there's a secular trend against them. 2, petrochemical companies, the refineries, there's replacements, right? There's new replacements for them. Somebody asked about the REITs. Iron Mountain, I'm intimately familiar with. I'm just telling you, they have a reckoning coming. They cannot compete in the field that they're trying to get into. And their core profits are shrinking. Somebody says, why do I have O on my don't buy list? I don't want any of the retail REITs. I don't want any of the residential REITs. Why? Talk about it. Because the businesses face headwinds. They're incredibly sensitive to what? Tighter credit. We have the easiest credit in the history of the world right now. And when, not if, when credit gets tighter, all of these companies are going to give back all of the coronavirus crash post gains. They're all going to revisit, I say all, it's most of them are going to revisit their lows. Because refurbishing retail, Simon, all of them, and adjusting the residential, climate change, is going to be expensive. They have no ability at this point to improve their margins or their profitability. None, 0. Because they have headwinds on the business side and on the credit side. I don't have them all in red. Some of these I have to study. Digital Realty Trust is usually a good one, but they're probably just overpriced. So usually when they come down to about here, you gotta look at them. You go through this. Some of these chemical companies are in trouble. A lot of these companies are in trouble. A lot of these utilities are in trouble. So when I have this all color-coded out, what you're going to see is that I'm right. It's at least 100 companies in the S&P 500 are in trouble. So I'm going to pull up UDR here. Pull up a chart. So a lot of people like UDR. So it popped up on the screen this week, so I started doing the reading. UDR is an okay company. They're okay. Nicely diversified residential realty REIT. Pretty good operations, good management. I think they do things about right. Problem is that even though they do things about right, they're still really not doing all that well, historically speaking. Why would I say that? It was pretty easy to see. Let's take a look at UDR. Is UDR really a good company? Okay, is it really a great company stock? Deficit spending era begins. Finally get the speculative bubble, and then a crash. Look at that. 1990, 2008, same price. 18 years, same price. From peak to peak, 13 years. Now we have the age of QE. Coronavirus crash brings it all the way back. And now super QE. So what happens in this air pocket here? This is a spot where there wasn't a lot of demand for the stock. And we can look at that over different time frames. Coming back down here, eventually, how sexy of a stock is this? 2007 to 2021. It should be 14 years, I guess. Look at that. Is this really a great buy and hold investment if it brought you all the way back to here? Well, maybe if you bought it here, sure. Do we believe that this is as low as it goes, this area here? Maybe. Does that mean you should be buying it up here, own it up here? I don't think you can buy it until it's back down in here. And there are over 100 stocks that I could tell that story on. So let's take a look at how I'm picking things compared to everyone else. This is the VSL, which is just my watch list. This is the S&P 500. This is UDR. Go back as far as you want. My watch list, which I'm only trying to take the best things from, UDR, S&P 500, my watch list, the VSL. And you can reconstruct this, which I'm in the process of doing, really easily using tip ranks. Not just my buys, but my watch list is on there too, which is basically the VSL. And because I'm lazy, I haven't taken some things off that I had on there years ago. I just keep track of my spreadsheet. What I'm telling you on how to invest, if you doubt it, if you're like, well, but I don't like it that way, it's not my style, change your style. Because you're probably investing in the UDRs of the world. You're probably not beating the S&P 500. And I would bet that you haven't been beating the VSL. If you just bought the whole VSL, equal pieces, this is what the results would be. That's what this is. And it still has companies on there that I don't want because I watch them. This is, you see it says VSL Plus. It includes Pioneer, Total, companies I'm not going to invest in. But I think that Pioneer and Total are the best among that group. So they'll probably be the survivors and the ones that adjust the best. And at some point, they'll have monster profits. That's why Pioneer is way overvalued for what it's earning now. So everybody knows they're probably the best of breed. Does this not blow you away? I didn't even know it looked like this until I put it in. I downloaded one of these just to make an example. Somebody asked about dividend stocks. And really, this whole video is about why dividend stocks are going to get crushed. Because so many of these companies are borrowing, keep their businesses operating and pay this dividend, which is an inducement to get people to invest in mediocre and worse companies. I'm not against dividends. I'm against smoke and mirrors. So think about this. In an article that I'm writing right now, I quote Warren Buffett, who in 2012, his letter, you should read his 2012 letter, talks about dividends. Now, 3/4 of the companies Buffett invests in has a dividend, but it's not the companies everybody else is investing in. Why? Because he wants them to have sustainable cash flow growth. Don't invest in a company just because the dividend yield says 6%. Invest because they got that totally covered and it's going to grow. Because they're in a good business with good management and they're not overly leveraged. And there's only a few dozen of those, to be honest with you. And some of the ones that you'd want to invest in for the right reasons, Microsoft and Apple have dividends around 1 or 2%. And people, I don't like that. It's not enough dividend for me. Well, there's a financial theory out there, and I don't remember what it's called anymore. But it's basically, all things being equal, what really matters in finance. And if you need income, and most of you have most of your money in qualified plans, why do you care, given that the taxation is the same of dividends and capital, long-term capital gains right now? Why do you care if you're getting a dividend versus just selling the shares on a scheduled basis to get your income? Why do you care? Why does it matter how the income gets to you? If the taxation is the same, and it is, inside and outside of IRAs, why not say, I want the best companies, and if I need income, I will just sell a share on a schedule. You know who does that? Who does that? Who are the biggest perpetrators in the big scam in America? Who sells shares on a schedule? People that are way richer than you. All the executives. People bitch and moan about executives selling shares, but usually it's just to generate cash flow to pay the taxes, in most cases, or guys that don't have hardly any salary, they actually need it for their income. There's no tax difference. If you need $600 a month of income every month or every quarter, sell 1 share or 2 shares of whatever it is you own. Because you're in higher quality stocks, the growth will pay for that. Buffett talks about that. He lists 4 things that corporations should do with their money: improve the business, make good strategic acquisitions, do share buybacks, and if none of those things are available, then pay a dividend. So, buybacks before dividends. All these companies have more dividends. And in fact, the ones that I outlined issued shares, they diluted, drove their dividend bill up, and drove their share price down. They diluted. All those companies diluted. Every single one of them. So they sold shares. Why? Look, they can't cover their dividend. Their dividend coverage ratio is under 1. One of the reasons I'm not in Williams is because I worry a little bit about them. I think Kinder Morgan's on here too. Well, like I said, I have reasons to be in Kinder Morgan. And these numbers were way worse 3 years ago. Well, these are actually an improvement. They're an improving company. But a lot of these companies are headed on the downslope. Right? You take a look at Broadcom and you go, what the heck? Right? But at least they bought back a couple shares. They barely cover their dividend. But I suspect that that's a strategic decision. I know enough about them to know that it'd be pretty easy for them to sell off a thing, and then they'd be great, right? Because a big company, they got things they could sell. Take a look at UDR here, so I picked them out. Dividend per share, $1.45. Their FFO is only $1.70. They have no cash on a balance sheet. And they talk about how strategic their balance sheet is because of the way they handle the credit. But again, what happens if credit gets tighter? I'm not saying UDR goes to 0. What I'm saying is I showed you that chart on how volatile it is. During a tightening cycle, they'll have problems. Share price will drop. It'll go from the 50s to the 20s or 30s. But I got my dividend. I lost 40%. So All those things matter. So when I'm picking out stocks, and again, this is just my watch list, going back to 2007. The way I'm doing it is mostly right. Not perfect. I've made bad trades. So I don't trade a lot. I put the calendar on my side by making a series of decisions based on fundamentals for the most part, and using RSI and a couple other things on the technical side to find entries. Remember a couple of weeks ago, I told you to buy small caps. And a couple months ago, I told you to buy small caps. There you go, small caps. I really pounded it a month ago. What's rallied in the last couple of weeks as the bigger parts of the stock market declined? Right? Small caps have rallied. It's where we are in the cycle. And you have so many people invested in those dividend stocks that are about to get smashed when credit gets a little tighter. Now, a lot of them have already started moving down, and people are like, well, that's just the volatility in the market. No, that's the big people anticipating what's coming. They do it smooth because they have good traders. Guys like Shooter and me, handling their trades, hide what they're doing, dribble it out, pick the spots, don't disrupt the market, keep it orderly. You hear that word a lot, right? Orderly. Orderly is a dangerous word if the market's going down or into flattening strength. I'll just finish on this. There's a lot of dividend stocks out there that are worth buying, but there's more that aren't worth buying because they just don't beat better companies. You have to pick out the better companies. I don't always pick out the best ones. I get the secular trends pretty right for a long time. The only thing that's really tripped me up in 25 years is I was so good at the oil market that when it changed and time frames changed and politics changed and manipulations I didn't understand, right? The Saudi Arabians got me. They did. They got me. Not the first time, because I knew that the crash was coming. But I really didn't think it would take this long for oil to get up to $70, $80 a barrel, right? I said it 2-3 years ago. Now it's here. So what's next? I did that interview with Forex Analytics and said, I think oil's just going to be range bound for quite a while. It'd be pretty easy to trade that channel if you're a futures trader. Why will it stay range bound? Because so much of the oil industry has been beat up in America. But at some point, they're going to see the end. They're all going to rush to make their money. So oil will get cheap again. I don't know when. 3, 4, 5 years out. As the EV revolution comes at them faster, as carbon capture comes at them faster, as new laws about carbon emissions come out faster, as carbon taxes come out. At some point, all these countries with oil are like, well, we better get this shit on the market. Otherwise, we're never going to make any money. And our budgets are screwed. So I stay away from oil in general because I don't know what day that's coming. But the people who just trade it, I got a guy in Puerto Rico that I know that trades it. That's all he does is trade oil for the most part. A little bit of S&P and QQQ for fun, he says. But he just makes his day trade in oil every day. He makes his $1,500 or $2,000. And he goes to the beach. Bad life. But it's hard to trade any market. So the professionals are doing all right in oil. But all the amateurs that are trying to jump on, like I told you a couple years ago, I was out in New York at the traders conference and they were pushing futures and crypto and options. I think you got a lot of amateurs that don't understand what is behind the charts. When a dislocation to a chart comes, when the technical analysis breaks down, and it does, or they don't have the experience to know what something means, so they skip over it, or say, that's just, volatility. They miss the message in the technicals, because the technicals are a message about the coming fundamentals, or what the fundamentals are that aren't recognized really. So fundamentals lead everything, but technicals are kind of the storyteller. Where are we? Does the market appreciate this fundamental right now? Or is it just go, 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 Tina, FOMO? Or is it a warning flag? Something bad's coming. If I use technicals and I ask you to at least learn the basics, relative strength index, get it down. And stop investing in mediocre companies like UDR, right? Nothing horrible. I have nothing horrible to say about them. I'm just saying a picture is worth 1,000 words or 200 stocks. I really should just have the Blue Mound 200. All right. Have a great weekend. Monday afternoon is the question and answer, along with a bunch of prepackaged stuff on stocks of the week and retirement income options. And we'll get this out today. I think I will. I'll do it right away. I have an errand to run at 2 and then a Brewer game tonight, but I will get this published between the errand and the Brewer game. So 5-ish this afternoon, this will be up. And I really like to see more of you in chat. The chat rooms, a lot of you have expertise in certain things. You know, I got one guy here that understands real estate in Hawaii. See another guy here, entertainment, technical analyst, 2 technical analysts, people in California, Ohio, Google. I see you. Get into the chat room, because one of our best ideas is this new Stone Co. I think it's going to be a best idea. And I had forgotten all about it. I knew who they were because I studied Warren Buffett's holdings, so I forgot about them. Right, Brazilian tech, fintech. That came from somebody in the chat room. Hey, take a look at this. You remember this? I said, oh yeah, I kind of remember that. I need your help too. You should help each other. And get this. Forget this. This is just the watch list. That's why I get into a basket of 20 to 30 of these. So, all right. Have a great weekend.